We need to get a historical perspective of where we are, and there is no one better to do that than Greg Fleming, Chief Executive Officer of Rockefeller Capital Management, who spent decades running Merrill, running Morgan Stanley Wealth Management and Investment Management. You have perspective running the big wealth management shops of Wall Street throughout history. So what is the best analog from a historical perspective for the moment that we're in?
You know, Lisa, it's interesting. If you're looking at analog, I'd pull back pieces from different times. So we're still in the time that we were in the last 10 or 15 years, where technology's driven deflation and prices coming down and productivity improvement. So that's still here. At the same time, we've got vestiges of the 70s and early 80s in terms of pressure on the energy side of the equation that we really haven't seen to that degree since then. And a real, inflation numbers this week that came in hotter than we've seen literally in decades. So you have a combination of historical times coming together to create the unique time that is 2022.
This moment was a pivot point this week when we got that 9.1% inflation print, when we got some of the data out of banks showing that they were suspending share buybacks despite the fact that it might be mandated by the Federal Reserve. How much do you view the markets as perhaps being overly pessimistic rather than not appreciating the difference of now versus a decade ago?
You know, I think the markets, there's a tug of war every time there's data out. I mean, today people said retail sales were better than they expected in June. Michigan sentiment was better, so they start to, markets go up, and it's like, wait a minute, maybe we'll get through the recession risk and be able to bring inflation down. So you have this tug of war on the data constantly, but the reality is the biggest player here, and you all know this because we've seen this historically, the Fed is focused and needs to stay focused on inflation, and they will. They have got to change the expectations that are getting embedded from an inflation standpoint.
Greg, in the time we've got left, as Lisa mentioned, we want to go bigger and broader with you. And I don't think you've ever gotten the credit for literally inventing modern wealth management. How does it feel like to see every single firm out there do a press release that says, we want to be like Greg Fleming, we need to go to Asia to gather high net worth assets. Gorman's doing 28% gross at the shop you invented at Morgan Stanley. Every Credit Suisse has announced, UBS, of course, leading the way, but Credit Suisse wants to be Greg Fleming. What do you say about an industry where everybody wants to get in?
Well, first of all, what that means is that the business is a good business to be in. And you know that, Tom. The characteristics of wealth management, fee-based advice, counsel to clients, recurring earnings. So it has characteristics, financial characteristics that make a lot of people want to be in the business. What I say, and this is what we're doing at Rockefeller Capital Management, is define the way that we're going to operate with competitive advantage. And what we're trying to do for clients is provide them advice across the full range of their needs through private advisors that are experienced on the investment side, open architecture, an investment platform where you bring in the best of outside managers. We've put together, and we marry that also with family office services. You know, we'll take care of bills, we'll help you with taxes. If you take care of the full needs of clients, you can offer something that not everybody else in the marketplace offers. So we've tried to redefine what it means with high net worth and ultra high net worth clients.
You and I have never seen a bond market like this. The Lehman, Barclays, the Bloomberg total return aggregate, negative 12%. Some of the corporate high grade stuff is negative 18%. How does quiet money manage with bond prices down 12%?
Well, you know, the reality is there are a number of things, including on the macro side, and I'll come back to this, but on the macro side, you have virtually full employment and everybody worried about recession. So there's things, Tom, that even we haven't seen. Back to Lisa's question, what are the historical analogs? There really aren't some for a number of the things we're dealing with here. In terms of the bond market, to have the equity market off as much as it's been this year and fixed income off to the degree that you described, that's something we haven't seen in history as well. So the quiet money was very careful about fixed income when rates were virtually zero across the spectrum.
How much have we fully appreciated the absence of Japanese investors, the absence of certain Chinese money, the absence of some of the international flows amid domestic crises throughout the world?
Well, I think that that's one of the things, Lisa, that's happening both on the financial flow side and even on the trade side, which is the internationalization and the globalization retrenching for really the first time in my career. In the 90s and in the first part of this century, people were focused on following those financial flows across markets from a trade standpoint, from an investment standpoint. All the major financial firms in the U.S. were trying to build major presence in those markets. And now you have a retrenchment back to home markets on both a financial basis to some extent, as well as on trade.
This is inflationary, and it is also perhaps a headwind to true growth, which raises a question of how long it will take before 60-40 works again.
Well, you know, for different clients, you might be rebalancing the 60-40 in a different direction. But I think it's going to take a while for the Fed and for the current situation to work its way out. When you have the kind of inflation numbers that you have now, people are talking about when we're going to be back to 2%. The reason they're going to go after this very aggressively is it's going to take some time to get back to 2%. They need to break the back of the expectation over the next 6 or 12 or 18 months in order to have a hope that a 60-40 portfolio in 24 or 25 might make sense for investors.
And now, folks, it's time for the Wall Street Week question Louis Rukeyser never would ask because this is a rude question. I'm going to ask it of you because you're qualified. I want you to tell me in banking, New York City banking, London banking, and such, the delicacy of chairman and CEO being held by one person at the same time. This is a debate that's out there. What is the efficacy of having a separate chairman and a separate chief executive officer?
You know, in theory, the efficacy is making sure that all the different alignment of interests are in place.
What's your experience?
My experience is it depends on the institution, and you've got a number of examples of very strong institutions with management, doing the right things across the landscape, and shareholder return being where you want it to be. And then you have situations where splitting the roles works. I think it really is. It boils down to looking at individual cases. Tom.
We have an astrolabe, one of those medieval clocks in the surveillance room where we meet every morning, and it's trying to gauge when Credit Suisse is taken out. And the basic idea there is American banking, the siren call of going over across the Atlantic and running into European banking headaches. Should the banks that you built and lived in, should they be buying European bank assets?
I think, Tom, it's more going the other way, to the point, Lisa, we were talking about before. I think that major financial institutions, but also, again, back to trade, I think
regionalization.
It's coming back, and it's the first time in 25 or 30 years that that's happened.
Well, to that point, and just to be clarified that orb is an 8-ball, I am wondering whether the expansion into China and into some of the...
I think it's
John's 8-ball.
It's in British.
It has the football game of his choice on the backside of it. I'm wondering, though, do you expect to see some retrenchment from financial firms' Chinese arms in the face of some of the international fissures as well as the zero-COVID policies?
Yeah, I don't know about a retrenchment, but much more caution in terms of the level of capital investment, the aggressiveness of the growth strategy. There's no question. In fact, Lisa, you can take it further. You know, I think you're going to see critical industries start to come back on more of a regional basis. And it's an opportunity for the United States, actually, where manufacturing of precision products could take place increasingly here. And who would have thought we would have been talking 5 years ago about pulling manufacturing of semiconductors, of clean energy, and some of the.
Yeah, but all of these things are inherently inflationary. These all are inherently inflation, especially with the dollar where it is, especially because it is cheaper to go overseas and to do it elsewhere. How do we bake that in to our market calls?
Well, I don't disagree with you. I think that a lot of these things are inflationary, and this is why I said that the Fed is going to, in rhetoric and in reality, stay right on top of this, because they recognize now that they've got expectations out of whack that they have to pull back. They've got some macro, like what you're talking about, Lisa, where regionalization could create more inflationary pressure that nobody would have conceived of 5 years ago.
Greg Fleming, 1 minute on a Friday evening. You executed this, which was the birth of BlackRock. What a triumph for Mr. Fink, the way they have done that, the way they have executed, not so much wealth management, but almost wealth husbandry. Did you see that coming, or have you been stunned at the success of BlackRock?
It was impossible, Tom, given the magnitude of success, to see it coming. We took it public, by the way, in 1999 at $14 a share. We merged Merrill Lynch's asset management business, as you know, in 2004 or 5 into BlackRock and took back a 49% ownership stake. I'm proud of the role that I played and that we played in helping create that firm. But it would have been hard to conceive of a firm with $8, $9, $10 trillion in assets under management. And that doesn't even really reflect the dominance they've created in certain spaces.